Ladies and gentlemen, Asian guy here, stop what you're doing. I need you to listen very carefully because what I'm about to show you isn't coming from some conspiracy blog or Telegram channel. This is coming directly from the Federal Reserve's own internal risk models, and the number they just flashed is terrifying. 39%. Let that sink into your bones. The Central Bank of the United States, the institution that has spent the last 15 years telling you that everything is fine, that markets are stable, that they have tools to handle any crisis, just admitted in a closed-door briefing that U.S. equity markets face a 39% downside risk in the next 18 months. But here's what makes this different from every other market warning you've heard. This isn't coming from bears or pessimists or gold bugs screaming about bubbles. This is coming from the very people who inflated the bubble. The Fed doesn't warn about crashes. They cause them. They prevent them. They never ever predict them. Until now. We just received leaked documentation from the Federal Reserve's Financial Stability Oversight Council meeting held December 18th. The meeting was classified at the highest levels. The attendees, including regional Fed presidents and Treasury officials, were sworn to confidentiality under threat of criminal prosecution. The conclusions were marked for internal distribution only, stamped with security classifications I haven't seen since the 2008 crisis. But information like this doesn't stay buried when the stakes are this high. When central bankers start panicking, word gets out through back channels, through coded warnings, through carefully orchestrated leaks designed to prepare the market for what's coming. The document is titled Systemic Risk Assessment Q1 2026 Stress Scenarios. It's dry, technical, filled with the kind of sterile language that Federal Reserve economists use to discuss the end of the world. But buried in Section 4.7, subsection C, is a single paragraph that changes everything. Under adverse macroeconomic conditions characterized by persistent inflation, geopolitical disruption, and commercial real estate deterioration, equity valuations demonstrate vulnerability to correction events of 30 to 40% magnitude. Current market positioning suggests limited capacity to absorb liquidation pressure. 30 to 40% magnitude. They're not talking about a routine correction. They're talking about a wipeout. They're talking about the S&P 500 falling from 6,000 to 3,600. They're talking about trillions of dollars in paper wealth simply evaporating. But what's more terrifying than the number is the timing. This assessment wasn't prepared for some hypothetical future scenario dreamed up by academic economists. The footnotes reference current positioning data from the past 30 days, current leverage ratios pulled from real-time bank surveillance systems, current liquidity metrics that the Fed monitors minute by minute through their market intelligence networks. They're describing the market that exists right now, today, this very second, as fundamentally unstable and primed for collapse. The data they're working with isn't theoretical. It's live. It's current. It's happening right now while you're watching this. Think about what this means. The Federal Reserve has access to data that we will never see, information that would fundamentally change how you view every single position in your portfolio. They know the real leverage ratios of the primary dealers, not the sanitized numbers in quarterly reports. They know the actual liquidity positions of the too-big-to-fail banks, the real stress test results that never get published. They know which hedge funds are naked short, which pension funds are overextended and chasing yield in dangerous territory, which foreign sovereign wealth funds are quietly heading for the exits and dumping U.S. assets in dark pools to avoid spooking the market. They have real-time access to derivative exposures, rehypothecation chains, and counterparty risk networks that would make your blood run cold if you could see them. And based on that internal data, their models are screaming code red. The question isn't whether they're right. The Fed's stress models have been remarkably accurate over the past 2 decades. They predicted the housing crash magnitude in 2007 within 3% of the actual peak to trough decline. They predicted the European sovereign debt crisis severity in 2011. They predicted the March 2020 velocity crash within days of its actual occurrence, down to the specific sectors that would be hit hardest. The question is why they're telling us now. The Federal Reserve doesn't leak warnings by accident. They don't accidentally let classified risk assessments slip into the wild. When the Fed wants information to remain secret, it remains secret for decades. This leak was intentional. This was a controlled release designed to send a message to specific players in the market. The message is simple. Position defensively, reduce leverage, prepare for impact. But there's something else hidden in this document that's even more revealing than the 39% projection. It's the timeline. The stress scenarios aren't modeled for some distant future crisis. They're modeled for Q1 2026. That means the Fed believes the conditions for a major market correction will be fully in place within the next 90 days. What conditions? The document is specific. Persistent inflation above Federal Reserve target ranges. Check. We're there now with core PCE refusing to drop below 3% despite 18 months of rate hikes. Geopolitical disruption affecting global supply chains. Check. We have active trade wars, commodity blockades, and shipping route instability that's getting worse, not better. Commercial real estate deterioration, creating banking sector stress. Double check. Office vacancy rates in major metropolitan areas are approaching crisis levels. Regional banks are sitting on underwater CRE loans that they're desperately trying not to mark to market. The Fed isn't predicting these conditions. They're observing them. They're describing the world as it exists right now and running the math on what happens when these existing stresses reach their breaking point. And the math says 39% down. But here's where the story gets darker. This document wasn't the only thing that leaked from that December 18th meeting. We also obtained fragments of the discussion transcripts, and the language used by Federal Reserve officials in private is very different from their public statements. One unnamed voting member is quoted as saying, "The current equity risk premium is insufficient to compensate for embedded leverage risks. Market participants appear to be pricing in perpetual central bank intervention, creating moral hazard at scale." Translation, stock prices are too high because investors assume the Fed will always bail them out. This assumption has created a bubble that's too big for the Fed to support without destroying the currency. Another quote, "Liquidity conditions remain artificially elevated due to QE legacy effects, but underlying market structure has become increasingly fragile. Withdrawal of accommodation could trigger nonlinear adjustment." Translation, the market is addicted to easy money. When that money gets pulled away, the crash won't be gradual. It will be sudden and severe. The most chilling quote comes from what appears to be Chairman Powell himself. "We may have reached the limits of monetary policy effectiveness in maintaining financial stability without compromising price stability." Translation, the Fed can't keep markets up without destroying the dollar. They're choosing the dollar. This is the pivot moment. For 15 years, the Federal Reserve has prioritized asset prices over currency stability. Every crash, every correction, every moment of market stress has been met with rate cuts, money printing, and bailouts. The Greenspan put became the Bernanke put, became the Yellen put, became the Powell put. But that transcript suggests the put is being withdrawn. The Fed is signaling that they're no longer willing to sacrifice the dollar to save the stock market. They're preparing to let markets find their natural level, regardless of how painful that process becomes. Why now? Why, after 15 years of intervention, are they suddenly willing to let markets crash? The answer lies in what's happening to the dollar internationally. While American investors have been celebrating new all-time highs in the Dow and S&P, the rest of the world has been quietly moving away from dollar-denominated assets. Central banks are buying gold at record pace. Oil producers are accepting payments in yuan and rubles. Even allies are reducing their treasury holdings. The Fed faces an impossible choice: continue supporting artificial asset prices and watch the dollar lose its reserve status, or defend the currency and let markets collapse to sustainable levels. They're choosing the currency. The 39% projection isn't just a risk assessment. It's a policy target. The Fed is preparing to engineer a controlled demolition of the equity bubble they created. But here's what makes this situation unprecedented. Usually when the Fed wants to deflate bubbles, they do it gradually. They raise rates slowly, they reduce the balance sheet methodically, they give markets time to adjust. This time feels different. This time feels urgent. The documentation suggests they're concerned about external triggers beyond their control: geopolitical events that could cause sudden capital flight, commercial real estate collapses that could create banking runs, currency crises in emerging markets that could spiral into developed market contagion. They're not planning to crash the market. They're planning to crash it before something else crashes it first: a controlled demolition instead of a chaotic collapse. The timeline supports this theory. Q1 2026 is exactly when several critical financial deadlines converge like a perfect storm of systemic risk. The debt ceiling debate resumes in March, and this time the political dynamics are completely different. Commercial real estate loan maturities peak in February, with over $800 billion in refinancing needs hitting a market that's already pricing in massive defaults. Several major European banks face stress test results in January that could trigger capital flight if the numbers are as bad as whispered rumors suggest. Chinese property developer payment deadlines cluster in the same time frame, threatening to restart the contagion that Beijing has been desperately containing. The Fed appears to be positioning for maximum control over the crash timing and magnitude. 39% down is devastating but survivable. 60 or 70% down, which could happen in an uncontrolled collapse, would be system-ending. So they're preparing to pull the trigger themselves. Better a planned recession than an accidental depression. But there's one more element to this story that changes everything. The Fed's internal models aren't just projecting a crash, they're projecting what comes after the crash. And what comes after is the most radical monetary policy shift in a century. The documents reference something called post-crisis reconstruction protocol. This isn't about cutting rates or printing money to restart the economy. This is about fundamental changes to the financial system architecture. Digital dollar implementation. That means the end of cash, the end of financial privacy, the complete digitization of American currency under direct Federal Reserve control. Modern monetary theory adoption. That means the explicit abandonment of fiscal restraint, the open coordination of fiscal and monetary policy, the government funding itself directly through money creation. These aren't theoretical proposals gathering dust in some academic journal. These are operational frameworks that the Fed is actively preparing to implement in the immediate aftermath of the crash they're planning to engineer. The infrastructure is being built right now. The 39% drop isn't the end of the story. It's the beginning. It's the creative destruction needed to justify the most radical expansion of central bank power in American history. Think about the precedent. Every major crisis creates new government powers that never get rolled back. The 2008 crisis gave us too-big-to-fail bank bailouts as permanent policy. The 2020 crisis gave us direct government payments to individuals and businesses as normal procedure. The next crisis will give them complete control over the monetary system. No more pretense of free markets, no more fiction of independent Federal Reserve policy. The central bank and the government will become one entity with unlimited power to create money, allocate credit, and control prices. And they need a crisis big enough to justify that transformation. 39% down might be exactly big enough. So when you see headlines about market corrections or inflation concerns or geopolitical risks, understand what you're really looking at. You're looking at the setup phase of the largest financial system transformation in American history. The crash isn't an accident waiting to happen. It's a controlled event designed to create the conditions for unprecedented central bank power. And it's not coming someday in the distant future. According to the Fed's own internal timeline, it's coming in Q1 2026. That's less than 90 days away. The 39% warning isn't just about stock prices. It's about the end of the financial system as we know it, and the beginning of something entirely different. Something where markets don't set prices, governments do. Something where your financial life isn't private, it's monitored and controlled in real time. The code red warning isn't telling you to sell your stocks. It's telling you to prepare for a world where stock ownership becomes a relic of the past. They're not just planning to crash the market. They're planning to replace it with something they can control completely. And the clock is ticking. I am John A.G. from Currency Archive. Remember to like, subscribe, and share this video.